This is my investment tier list. And look, everyone and their grandma has an opinion on where you should put your money. Your uncle thinks crypto is going to make him a millionaire. Your bank is telling you their savings account is all you need. And some random guy on the internet is trying to sell you a course about flipping houses. That is why I made this investment tier list. To cut through all the noise and show you what actually builds wealth over time, what is just okay, and what you should avoid completely unless you enjoy watching your money disappear. In this tier list, we have 3 tiers: must-have, mid, and trash. We are going to start from the bottom and work our way up to the stuff that genuinely changes your financial life. Let's get into it. Meme coins and NFTs. Let's start with the most obvious one. Look, I am not here to tell you that nobody has ever made money off meme coins or NFTs. Some people have, and good for them. But let's be real. For every person who bought Dogecoin at the right time, there are 10,000 people who bought it at the wrong time and are now holding a bag of nothing. This is not investing. This is gambling with extra steps and a lot more Twitter. The problem is that meme coins and NFTs have no underlying value. A stock represents ownership in a real business that generates real revenue. A bond is a loan that earns real interest. A meme coin is worth exactly what the next guy is willing to pay for it. And when the hype dies, that number goes to 0 faster than you can say, rug pull. If you enjoy the thrill and you can genuinely afford to lose every single dollar you put in, then treat it like a casino trip. But calling it an investment? That is a big no from me. Day trading, the dream that YouTube ads love to sell you, the guy with the Lambo, the multiple monitors, the beach house, all from trading stocks for a few hours a day. Here is the reality. Studies consistently show that around 90% of day traders lose money over time. And it is not because they are dumb, it is because they are competing against algorithms, institutional investors, and people who do this professionally with millions in resources behind them. Day trading also has a huge hidden cost that nobody talks about: taxes. Every trade is a taxable event. So even on the days you win, the government is taking a cut. Add in trading fees, the emotional toll, and the sheer amount of time it takes, and you have a part-time job that statistically pays you less than minimum wage. If you love the markets and want to engage with them actively, that is completely fine. But do not quit your day job. Do not remortgage your house, and definitely do not let some influencer convince you this is a passive income stream, buying a new car as an asset. This one might surprise a few people. A car is not an investment. The second you drive it off the lot, it loses around 10 to 20% of its value. By year 5, it has lost more than half. You are also paying insurance, maintenance, fuel, and registration on top of that. It is one of the most expensive things most people own, and it goes down in value every single day. Now, obviously people need cars to live their lives. I am not saying do not own a car. I am saying do not call it an asset or justify buying a more expensive car than you need because it holds its value. It does not. Buy what you need, drive it for as long as possible, and put the money you would have spent on unnecessary upgrades somewhere that actually grows. Gold and precious metals. Now, before the gold bugs in the comments come for me, let me explain. Gold is not a terrible thing to own. It has been a store of value for thousands of years. It holds up well during periods of inflation, and it does not carry the same kind of counterparty risk that stocks and bonds do. In a genuine global economic meltdown, gold would probably do just fine. But here is the thing. Over the long run, gold does not grow your wealth. It preserves it. Between 1980 and now, the stock market has massively outperformed gold. Gold does not pay dividends. It does not generate earnings. It just sits there. So if your goal is building wealth over 20 or 30 years, gold alone is not going to get you there. As a small hedge, maybe 5 to 10% of your portfolio, it is perfectly reasonable. As your primary strategy, mid-tier at best. High-yield savings accounts and CDSA. High-yield savings account is not glamorous. It is also not going to make you rich, but it has a very important job, and it does that job well. If you have money you are going to need in the next 1 to 3 years, an emergency fund, a house down payment, money for a car, a high-yield savings account is exactly where it should be. You are earning somewhere around 4 to 5% with 0 risk and full liquidity. That is genuinely useful. Certificates of deposit, or CDS, are similar. You lock your money up for a set period and earn a fixed rate. The downside is that the money is not accessible without penalties. The upside is that the rate is guaranteed. Both of these tools have a role to play in a smart financial plan. But if you are keeping your long-term wealth-building money in a savings account because it feels safe, you are letting inflation slowly eat your purchasing power. They are a tool, not a strategy. Bonds. Bonds are the boring kid at the party who turns out to be a genuinely reliable friend. When you buy a bond, you are essentially lending money to a government or corporation and earning interest in return. They are less volatile than stocks, they provide steady income, and they tend to hold up better when markets crash. For that reason, they are a staple in almost every serious long-term portfolio. The reason they are mid and not must-have is that on their own, bonds will not generate the kind of returns you need to outpace inflation over decades. They are a balancing tool, not an engine. The older you get and the closer you are to needing your money, the more bonds make sense in your mix. When you are young, keep them as a smaller slice and let your growth assets do the heavy lifting. Emergency fund first. Before you invest a single dollar anywhere, you need this: 3 to 6 months of living expenses sitting in a liquid account. Not invested, not tied up, just available. I know it is not exciting. I know you want to talk about stocks and index funds, but if you do not have an emergency fund and your car breaks down or you lose your job, you are going to be forced to sell your investments at the worst possible time. That wipes out months or even years of gains in one bad moment. The emergency fund is not an investment. It is protection for your investments. Think of it as the foundation the entire rest of this list is built on. You cannot build on sand. Get this sorted first, and then we can talk about everything else. Index funds and ETFs. Here it is, the boring, unglamorous, completely unsexy answer that has quietly made more millionaires than almost anything else. Index funds. An index fund tracks a broad market index. Think the S&P 500, which includes the 500 largest companies in the US, and gives you a tiny ownership stake in all of them. When the market goes up, you go up. When it goes down, you go down. But over a long enough timeline, the market has always recovered and gone higher. The real magic is compounding. If you invest consistently over 20 or 30 years, reinvesting your returns, the growth becomes exponential. Warren Buffett, one of the greatest investors alive, has publicly told most people that a simple S&P 500 index fund will beat the vast majority of actively managed funds over time. And he is right. Most fund managers cannot consistently beat the market, and they charge you fees to underperform it. ETFs, or exchange-traded funds, work similarly but trade like stocks throughout the day, giving you slightly more flexibility. Both are excellent. The key is to invest consistently. Do not panic sell when the market drops, and let time do the work. That is it. That is the strategy. It is not exciting, but it works. Employer 401k with matching. If your employer offers a 401k match and you are not taking full advantage of it, I need you to stop what you are doing right now. An employer match is free money. Literally free. If your company matches 50% of what you contribute up to 6% of your salary, and you are not contributing at least 6%, you are leaving part of your compensation on the table every single pay period. On top of the match, 401k contributions are tax-advantaged, meaning you either pay taxes now and let the money grow tax-free, or you defer taxes until retirement. Either way, you are getting a massive government subsidy to invest. This is not complicated. Contribute at least enough to get the full match. Then max it out if you can. Then open a Roth IRA. In that order. Real estate done right. Real estate is a legitimate must-have, but I put it last in this tier because it comes with a massive caveat. Done right. Real estate done wrong. Buying more house than you can afford, buying in the wrong market, or treating every property as an investment can set you back years. But real estate done right is genuinely one of the most powerful wealth-building vehicles that exists. Owning your primary home builds equity over time and protects you from rising rents. Investment properties can generate passive rental income and appreciate in value simultaneously. And unlike stocks, real estate comes with leverage. You can control a $400,000 asset with $80,000 down and let a tenant help pay off the mortgage. That is a powerful concept when the numbers work in your favor. The key is doing your homework. Understand the market you are buying in. Make sure the rent covers your mortgage, taxes, insurance, and maintenance, with something left over. Do not buy emotionally and have reserves for when things go wrong, because they always eventually do. Real estate is not passive. but the wealth it builds can be extraordinary. And that is how the final tier list looks. Real wealth is built slowly, consistently, and without drama. The people who try to shortcut it are usually the ones funding the people who did not, and I will see you in the next one.